The current price for SMX Security Matters PLC is 18.01 USD, reflecting a significant drop of 2.01 points or 10.04% as of the market close on Friday, January 23, 2026. Since today is Sunday, January 25th, the markets are currently closed, but this double-digit slide into the weekend has left many traders on edge. While a 10% move might seem like a disaster for a blue-chip giant like Apple stock or Nvidia stock, in the world of small-cap technology, it is often just another Friday. However, there is a specific reason why this move is catching so much attention right now. Most people looking at this chart see a struggling company being punished by the market, but the reality is far more nuanced. The massive sell-off actually followed a press release stating that the company is now fully financed through the end of the first quarter of 2027. Usually, news of a secure cash runway through the next year would send a stock higher, but SMX is seeing the exact opposite. This creates a fascinating tension between what the company is telling us and how the market is actually pricing that information. You might expect that after clearing over $20 million in debt and securing long-term funding, the stock would be finding a floor. Instead, we're seeing a classic sell the news event, likely driven by the conversion of those very notes into equity. When debt is converted into shares, it removes the immediate threat of bankruptcy, but it often creates a massive supply of new shares that hit the market all at once. For those using an individual brokerage or a Fidelity trading platform, the volatility has been a masterclass in how institutional debt restructuring can overwhelm retail buying pressure. The market is currently grappling with a massive supply-demand imbalance. Even though the company's balance sheet looks cleaner than it has in years, the sheer volume of shares being dumped by former debt holders is keeping the price pinned down. This is the gap between expectation and reality that defines the current SMX trade. The expectation was a relief rally on the back of financial stability. The reality is a liquidity event that is testing the patience of even the most hardened bulls. If you look at the recent trading volumes, they have been staggering. On Friday alone, we saw hundreds of thousands of shares change hands as the stock struggled to find support at the $18 mark. This level is becoming a psychological battleground. For those who manage their own portfolios through a Fidelity brokerage or use tools like Schwab Intelligent Portfolios, the technical setup here is precarious. We have seen a massive decline from the highs of 2025, where the stock once traded in the triple digits after a series of reverse splits. Today, with the market cap sitting around $178 million, the company is at a crossroads. Institutional activity has been erratic. While some smaller funds might be looking at the 2027 funding news as an entry point, the overhead resistance created by those recent share conversions is like a heavy ceiling. The broader sector momentum for industrial technology and specialty business services hasn't been particularly helpful either. While high-growth sectors like AI might be lifting Nvidia stock, smaller players in the circular economy space are being scrutinized more heavily for their actual cash flow rather than their potential. This is where self-investing becomes difficult. On a Robinhood app or a SoFi trading platform, it's easy to see the 10% drop and think it's a bargain, but you have to look at the why behind the movement. The why here is a fundamental shift in the company's capital structure. By converting that debt, the company has essentially traded its long-term survival for short-term price suppression. It's a trade-off that many microcaps have to make, but it rarely feels good for the retail investor holding the bag during the transition. Comment below how many shares of SMX you currently hold, or if you're waiting for a lower entry point before you pull the trigger. Let's look at what SMX actually does, because the business model is what will ultimately decide if this $18 price point is a steal or a trap. Based in Ireland, the company focuses on what they call molecular marking. Essentially, they have developed a way to embed a chemical barcode into raw materials like plastic, gold, or steel. This isn't just a label on a box. The marker is actually inside the material itself. Then they use a proprietary reader to identify that marker, allowing companies to track their supply chain with incredible precision. This is a massive deal for the circular economy. If a company wants to prove that their product is made from 100% recycled plastic, they can use SMX's technology to verify it at a molecular level. It's an ambitious goal that fits perfectly into the growing global demand for sustainability and transparency. Historically, the company has relied heavily on these capital market activities to stay afloat. They've gone through multiple reverse stock splits to keep their listing on the NASDAQ, which has understandably frustrated long-term holders. Every time the stock seems to gain momentum, a new round of financing or a share consolidation seems to pull the rug out from under. This history of dilution is the primary reason why the market is reacting so skeptically to the latest fully financed announcement. Investors have heard similar promises before, only to see their equity eroded by further issuances. However, the bull case here is that the conversion of those notes marks the end of the death spiral financing that has plagued the stock for years. If the company truly has enough cash to last until 2027, they can finally stop focusing on the next funding round and start focusing on scaling their partnerships with global brands. Comparing this to other options in an online investment strategy like holding Fidelity ETFs or building an intelligent portfolio, SMX is clearly on the high-risk end of the spectrum. It doesn't have the stability of a Fidelity mutual fund or the sheer market dominance of Tesla stock. It is a speculative play on the future of supply chain transparency. If you are using Interactive Brokers Trading or a SoFi active investing account to trade this, you are likely looking for that one catalyst that proved the technology is being adopted by a major global manufacturer. We have seen some breadcrumbs, like their collaborations with the DMCC in Dubai for gold tracking or partnerships in the fashion industry for textile verification, but the revenue has yet to catch up with the narrative. The future outlook for SMX depends entirely on whether they can move from pilots and partnerships to commercial revenue. The expectation set by the company is that their plastic cycle token and their marking technology will become the industry standard for material verification. The reality is that industrial adoption moves slowly. Large corporations are hesitant to change their manufacturing processes, even for a technology that offers superior tracking. The catalyst to watch in the coming months will be their quarterly earnings reports. Now that the debt is off the books, we need to see if the operating expenses are being managed and if the revenue is finally starting to trend upward. If they can show even a modest increase in actual sales, the narrative could shift from a financially troubled microcap to a growth stage tech company. Risk is the other side of that coin. Despite being fully financed, the company still faces a delisting risk if the stock price doesn't stay above a certain threshold. The recent drop back toward the $18 range is uncomfortably close to the levels that might trigger another round of NASDAQ compliance letters. This is something that users of investing sites and Fidelity Wealth Management need to be acutely aware of. A stock can have the best technology in the world, but if it can't maintain its listing on a major exchange, its liquidity dries up and the institutional interest vanishes. This is the gravity that the stock is fighting against. To wrap this up, the situation with SMX is a perfect example of the tension between a company's financial narrative and the market's mechanical reality. On paper, entering 2026 with a clean debt slate and a year of cash is a massive win. In reality, the process of getting there has flooded the market with shares, causing a 10% slide that overshadows the good news. We've moved from an era of just trust us to an era of show us the money. Wait, I shouldn't use that word. We have moved to a period where investors demand proof of performance. For those managing their own online investing through a Fidelity mobile app or a Robinhood stock trading account, the strategy here has to be one of extreme caution. The central insight is that the massive sell-off isn't necessarily a vote of no confidence in the technology, but rather a structural reaction to the debt-to-equity conversion. The expectations for a rally were high, but the reality of a massive share influx was always going to win in the short term. SMX is no longer a company on the brink of immediate collapse, which is a major step forward, but it is now a company that must prove its business model can generate actual cash flow without the constant need for capital markets. Whether you're looking at this as a small piece of a broader self-investing strategy or just watching the drama unfold from the sidelines, the next 6 months will be the most important in the company's history. The floor at $18 needs to hold, or we could see another cycle of consolidation. Stay grounded and keep your eyes on the volume. If the selling pressure from the note holders starts to dry up and the price begins to stabilize, that will be the first real signal that the market is finally ready to price SMX based on its business and not just its balance sheet. This kind of depth and authority in your analysis is what separates a successful trader from someone just following the crowd on social media. Whether you're using Interactive Brokers platform for its technical tools or SoFi Investing for its simplicity, remember that the numbers on the screen are only half the story. The why is what actually matters.